Hey everyone, FSLY stock dropped even more after the company reported disappointed earnings results. Now the stock price is down 89% off its high reached in 2020-2021. So is this a buying opportunity? Should investors buy the dip in FSLY stock? That's the question I'm going to answer in this video. So let's jump in, let's take a look at the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
I mentioned that the stock price is down 89% off the high. You can see the recent dip here following the earnings results, but the stock price has been down from highs reached in 2020. So let's take a look at some of the characteristics of the business. Number one, the company has demonstrated solid revenue growth at 505 million in the latest trailing 12-month period. However, management guided for mediocre revenue growth in the 13% range for the next quarter, 15% for the year, and that's disappointing Wall Street investors because this is a growth stock. It's valued like a growth stock. So if you're not demonstrating excellent growth, then your valuation needs to adjust. And I feel that's what's happening with FSLY. The valuation is getting an adjustment because of the slower growth expectations, which I'll share a little bit more about in just a little bit. First, let's take a look at the profitability, and looking at the operating profit margin, negative 38.28% in the trailing 12-month period. It has turned things around and it's making progress towards profitability, although not quickly enough apparently because Wall Street is not happy with the progress. However, it was, look at this, heading just straight downward, right? Negative 65% in operating profit margin. And now it's working its way up and making progress towards profitability. However, investors may feel that if it's going to make this much growth in operating profit margin, or if the pace of growth is going to be this slow in operating profitability, then it should demonstrate better revenue growth. It wants a bit of both, right? Not just one or the other. And that could be pressuring FSLY in an environment where the cost of capital has increased significantly. Looking forward for 2024, investors expect FSLY to deliver 15.6% revenue growth, and in 2025, 15.7% revenue growth, and in 2026, 15.8% revenue growth. So about 16% revenue growth over the next 3 years expected for FSLY stock. It's not bad at all, but investors are looking for something more from a company that's valued the way it is and it's losing so much money on the bottom line. You want to see more than just 15% revenue growth when you're paying this price and when the company is losing this much money on the bottom line. The next thing I wanted to share with you is the company's cash flow from operations to sales, and here's why that's important. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, Inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you understand that, you can see at 0.07, it's kind of broke above the break-even point of cash flow from operations. That's great news. It only achieved this in recent quarters. Look at the phenomenal improvement here in cash flow from operations to sales for Fastly, from negative 16% all the way up to 0.07%, all in about a year, as the company really focused on improving its cash flow from operations because the higher cost of capital, right? When the cost of capital is higher, you're less interested in generating losses on the bottom line, because now when you go out to ask for money from investors, the cost that you have to pay for that money is much, much higher. So Fastly has done a good job in changing things around, improving its cash flow from operations and operating profitability as well. Lastly, let's look at its valuation, and I want you to understand why the forward price to sales is important. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion, and the sales for the previous 12 months were $185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for $465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. Okay, so now that you've understood this as a viable valuation metric, you can see it's trading at a forward price to sales of 2.8, near the lowest it's been in the last 2 years according to this metric. However, if I was to say whether or not putting all of this together, if Fastly stock is a buy right now, I would say not just yet. Not just yet. I want to see a little bit more progress from Fastly in those initiatives in improving operating profit margin and cash flow from operations. If it can make continued progress on that front over the next 3 and 6 month period, and the valuation stays the same and the growth prospects stay the same, I could see myself upgrading this stock to a buy. But for now, I'm keeping it rated as a hold. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.